Well, it looks like the housing market is finally starting to cool off. Mortgage rates have gone from 3% to now over 7%, so they're more than double now. They're at or about where they were at the peak back before the '08 crash. Of course, interest rates do peak before you really have the big crash. Back when the housing market bottomed, we had, the Fed had rates all the way down at zero, and mortgage rates were pretty far down as well. I don't remember exactly where they were. But something that we have to keep in mind is that the a comparable increase in mortgage rates to the levels that they were, that triggered the last housing crash, it's not really equal when you look at it today, because back then you had a much higher percentage of adjustable rate mortgages, meaning that when the mortgage rates rose in the market, people's mortgage rates that they were paying rose, because their rate, they had a floating rate that moved with the market rate. So when the Fed raised interest rates, the Fed essentially raised everyone's mortgage rate who already had a house, and so therefore those people then were caught flat-footed. Their monthly mortgage rate doubled, and all of a sudden they were homeless. Because of that experience, there's a lot less people who get adjustable rate mortgages these days, and so you're not going to see folks losing their houses in the same way. And so we don't really have the same surge in supply that we saw back then. We're just having a drop off in demand. Back then, demand fell off a cliff and supply went to the moon. Right now, we're just having demand fall off a cliff. And that's an important distinction, because unfortunately, even though the housing market moves excruciatingly slow to begin with, it's going to move even slower in this case. Because all those folks who got into their house at very low rates, even if they end up underwater, they're not really, they don't have much incentive to sell right now, because even if they sold their house, at a high price right now, they wouldn't be able to afford to move, because their new house would then would have a mortgage rate, over 7%. And people are not going to deal with that when they're paying a 3.5% rate, let's say, in the house that they're in right now. And so, in order for people like that to justify selling their house, well, frankly, it's kind of a disincentive for them either way, because by the time that mortgage rates come back down, housing prices are probably going to fall pretty far too. Although mortgage rates will fall faster, I guess. So what we're going to have to see is this rise in mortgage rates is going to kill demand for housing. Housing is going to start to collapse because there's no demand. People can't afford to bid on these expensive houses, so they're going to get marked down, and there's just not going to be any buyers. Before long, the Fed is going to cut rates back down to zero, probably, just like they always do, because the stock market and the bond market will implode before the housing market really has the time to even go into bear market territory. And so we'll end up with a situation where housing prices, have started to fall, but they're still relatively high, and mortgage rates are back down again into the cheap zone. And at that point, some people might start exiting the housing market, selling their house while they still have some equity in it, and then taking that money and going to buy, a house that has depreciated even further, again, at a lower interest rate. Now, then again, the supply shock could come from the builders, because builders are building like crazy, especially around where I live, and as demand has fallen off a cliff, those builders will have to unload those houses. Those houses are still under construction. They're going to be completed, and the builders are going to have to put them for sale. And so that could bring down prices much faster, because even if existing homeowners or the owners of existing homes don't want to sell and don't have much incentive to sell, the builders do. And so the builders don't want to sit on all this inventory, and they will ultimately have to mark down these houses until they are at a price point where the principal on somebody's mortgage makes it affordable for them. Let's say somebody can afford $4,000 a month for a mortgage or rent, and the interest rate more than doubles. Well, then you're going to have to cut the principal by more than half in order to make up for it. Well, actually, I don't think the math quite works out exactly like that. My brain's still kind of foggy. I don't know if you can hear. I'm even more nasally than usual because I am still a little sick, and it is. But either way, I don't have time to do math in my head or to even work out the logic of it. But the basic principle holds that if the interest rate is going to go up and you want your monthly payment to stay the same, well, then you're going to have to cut the principal. Now, then again, even if these builders, let's say they make the calculation, you know what, let's just hold off because we think the Fed is going to cut rates at some point. Let's just hold these houses on the market, not selling at these high prices, or maybe don't even list them. Maybe just leave these houses complete, sitting empty, build whole neighborhoods and don't sell them, sit on this inventory until rates go back down and people can afford them. If they do that, we might find that the Fed is actually serious about fighting inflation. And if you are looking at the economy from a basic Phillips curve perspective, like the Fed tends to do, fighting inflation means jacking up unemployment and killing jobs, because the idea is that, okay, well, demand has gotten out of control because, too many people have access to good paying jobs. And so therefore the economy is overheating, say the Keynesians. And so the Fed is going to use monetary policy to try and trigger massive layoffs. And if they do that, well, those people all of a sudden can't afford such expensive, luxurious homes, and that is going to affect housing demand. And then we're back to a 2006 to 2012 scenario when everybody got laid off, everybody lost their jobs, and even if they found another job, they didn't find another job that paid as well as the one that they lost, and people were destitute, and they were not shelling out $350,000 for a crappy 2-bedroom, 2-bath, if you're lucky, house with a 1-car garage, if you're lucky. And so there is still a strong case to be made that housing prices will revert to the mean, which, all market prices eventually do. I still think that this argued that we entered a new paradigm around the start of the 21st century, where housing prices are just going to perpetually rise relative to people's incomes in the United States, and that's just normal. That all of a sudden housing is just going to consume more and more of your annual budget. It's just normal that back in the 1950s, as I've pointed out on this channel before, you could buy a single-family home, brand new construction, working a minimum wage job, one job. Nowadays, in order to afford a home, you pretty much need to work at least 2, but preferably 3 full-time jobs, each with a 6-figure salary. Call me crazy if I think that is unsustainable, and that once we start this process of unraveling this insanity, that, to borrow a phrase from Peter Schiff, the Fed won't be able to put that genie back in the bottle. Ultimately, as our as our economy collapses, housing prices, they don't even have to get cheap. They never got cheap after 2008. That's a myth. If anyone tells you, oh, housing was so cheap back in 2013 or 2012, they're lying to you. Or maybe they're just mistaken. Most people are probably just mistaken. It wasn't cheap back then. And that's so sick that people, were reduced. They're so beaten down that they think that was cheap. That was normal. That was normal from a historical perspective. Housing prices were where they should be relative to people's incomes. Housing was somewhat affordable back then. I knew people who, just were normal, hard workers, worked at the grocery store, not particularly highly paid or highly skilled work, and nice couples, or I'm thinking one couple in particular. They were able to buy a house, and they lived it. They had a kid. It was nice. And believe it or not, neither of them was a doctor, nor a lawyer, nor an investment advisor, CPA, any sort of professional, 8-year degree track. They were just normal people, and they were able to afford to live near where they worked. That's called normal. That's the way things should be. The United States does not have, a massively booming population. There's no reason why there should be a shortage of housing. That is a myth. And so, God willing, we will return to that sometime over the next few years. Because, again, even under the best case scenario, it's going to take like 4 or 5 years before things really get, good. Being in my mid-20s kind of sucks to think, hey, I'll be 30 by the time that, housing prices might be normal. I mean, I remember being a kid, and you could buy a house, like a small house, like 60-some thousand. I think I even saw some in the 50s. Fixer-uppers that were of a normal size, 3-bedroom, 2-bath houses, under 100, like 80s, 90s. And I'm not talking, time period. I'm not talking decades. I'm talking about 80s, 90s as in the price point. 80-some thousand, 90-some thousand. That's the way things were back then. And obviously adjusted for inflation to be much more now. Maybe a reasonably priced house these days would be like 150,000. And the same idea because the dollar has lost so much value in that time. And that's why I think, generally speaking, I look at housing prices today, most of them, you cut them in half, that's about where they should be. And I think if I looked at the long-term average and actually did the math, it would probably come right around to a 50%. That's about where things need to be. Now, it's going to vary, obviously, by area. Some areas need to fall more or less. So, with that said, I will see you folks back here tomorrow.